Welcome to the deep dive. Today, we're diving right into the recent fiscal fourth quarter 2025 earnings for Applied Digital. That's ticker APLD.
Yep.
Our mission, like always, is to look beyond just the press release headlines. We're going to view these results using our structured five-part framework.
Which is key here.
Right, integrating the company's own data with, real-time market expectations. The goal for you listening is really to pull out the most important bits of insight.
Yeah, get you informed without drowning you in data.
Exactly, a shortcut to being well-informed.
And that structured approach, it really helps, especially with complex financials like these. It lets us synthesize all this information, spot crucial patterns maybe others miss.
So it's not just what happened.
Exactly. It's about why it matters. We'll look at their data, compare it with verified market info, give you that context, help you connect the dots.
All right, let's get into it then. Let's unpack this. Now for slide one, the at-a-glance scorecard. This is our first look, kind of a high-level summary of Applied Digital's Q4 performance against what Wall Street was expecting.
The initial checkup.
Right. So for the fiscal fourth quarter, ended May 31st, 2025, Applied Digital reported total revenue of $38.0 million. Now, that was a clear miss against the consensus analyst estimate, which was $42.99 million.
Okay, so a miss on the top line.
Yeah. But then on the bottom line, diluted net loss per share from continuing operations came in at negative 12 cents.
And how did that compare?
Interestingly, that was exactly in line with the Wall Street consensus. They also expected a $1.12 loss per share.
So a miss on revenue, but hit the earnings target. That's often tells the story in itself.
It does. What's the immediate market reaction or sentiment then?
Well, what's clear is the market's having a bit of a nuanced reaction. Despite that revenue miss, initial analyst sentiment is still broadly positive. They seem focused on the company's long-term strategic shift, the pivot towards AI infrastructure.
So they're looking past the miss.
To some extent. The consensus rating is still a buy. But, and this is important, that optimism is definitely tempered. There's caution around near-term profitability pressures and, well, what some see as high valuation metrics.
Any signs of that caution?
Yeah, we actually saw one firm recently downgrade them from buy to neutral. So that reflects that kind of balancing act, future potential versus, current financial reality.
That's fascinating. So it's not just black and white, hit or miss. It's about the why and the future outlook.
Precisely.
So why are analysts still mostly positive despite the revenue miss? What's the signal overriding those numbers? And maybe more importantly, let's look beyond just this quarter. What does the year-over-year performance tell us about where the business is actually heading?
Great questions. The market often looks ahead, right? That hidden signal is usually tied to the strategic narrative of the AI pivot, which we'll definitely get into more. But first, let's hit that year-over-year comparison. Applied Digital's total revenue was up pretty strongly, 41.3%. That's from $26.9 million in Q4 last year to $38.0 million this quarter.
Okay, solid growth there.
Yeah. And their net loss, remember, smaller is better here, improved by 24.7%. It shrank from about a $35.3 million loss to a $26.6 million loss.
Also good, less loss.
But here's where it gets interesting. Diluted EPS, earnings per share, saw a huge improvement of 57.1%, going from a loss of 28 cents per share to 28.12.
Whoa. Okay, so EPS improved much faster than revenue grew. That's unusual sometimes.
It is. That's a much faster rate of improvement than the revenue growth.
So normally that faster EPS improvement might point to, better efficiency, maybe cost cutting, but you mentioned the operating loss actually got worse. How do we square that? What's driving the EPS improvement if it's not core operations?
Yeah, that's the complex part of the story. If you dig into the income statement, it definitely wasn't core operational efficiency driving that EPS jump. Like you said, their operating loss actually widened quite significantly. Went from $2.7 million last year to a pretty big $20.7 million loss this quarter.
Ouch. Why such a big jump?
Primarily because of a massive 115% surge in SG&A expenses. Selling, general, and administrative. They're investing heavily in this strategic transformation.
Okay, so where did the EPS boost come from then?
It came from two main things below that operating line. First, a really dramatic drop, 67% year over year in net interest expense. Went from $13.8 million down to just $4.5 million. That's a big help.
Lower financing costs, got it.
Yeah, exactly. And second, this improvement happened even though they faced a massive headwind from shareholder dilution. The diluted weighted average number of shares outstanding, it soared by almost 80%.
80%.
Yeah, from about 125 million shares to over 224 million. So for EPS to improve that much, despite that huge dilution, it really highlights just how powerful that reduced interest expense was.
That really puts it in perspective. And speaking of dilution, that soaring share count, it's often a critical thing for growth companies, isn't it? Could you just quickly remind our listeners why diluted EPS is the one we really need to watch here? Maybe more than basic EPS.
Absolutely. Good point. While many listeners know EPS, that difference between basic and diluted is pretty critical for growth stocks like APLD. Basic EPS is simple, right? Net income divided by basic shares.
Straightforward.
But diluted EPS is more conservative, more comprehensive. It includes not just the basic shares, but also all the potential shares that could be created from things like stock options, warrants, convertible debt stuff these companies use a lot.
Right, the what-if shares.
Exactly. It reflects a kind of worst-case scenario for ownership dilution. It gives you, the listener, a more realistic picture of earnings per share if all those potential shares actually converted. That's why it's the key metric to track for a company like this.
Excellent clarification, thanks. Moving to slide 2, the engine of profitability. Okay, now let's dig into the company's profitability at the operational level. We're talking margins, adjusted metrics. This helps us see the real health of the core business and the financial impact of their big strategy moves.
Right. Let's look under the hood, starting with gross margin. This tells us profitability after the direct costs of making revenue. And here we actually see a positive signal.
Okay.
Applied Digital reported a gross profit of $7.8 million in Q4. That works out to a 20.5% gross margin. And that's a definite improvement from Q4 last year, which was $4.1 million profit and a 15.2% margin.
So margins improving at the gross level, what does that suggest?
It suggests their existing data center operations, the ones generating revenue now, are getting more efficient. Or maybe they're getting better pricing. Either way, it's a good sign for the underlying health of those assets.
Okay, good news on gross margins. But then, as you hinted before, we look at operating margin, and it's a totally different picture, right? A stark contrast. What's going on there?
It really is. Operating margin factors in all the operating expenses, including that huge SG&A number we talked about.
Yeah.
And yeah, it tells a very different story. In Q4, the operating loss was $20.7 million. That gives you a deeply negative operating margin of negative 54.5%.
Minus 54%. Wow.
Yeah. Compare that to Q4 last year.
Yeah.
An operating loss of $2.7 million and an operating margin of negative 10.0%. So a big decline.
So what's the takeaway from that divergence? Good gross margin, terrible operating margin.
The divergence is really clear. Core operations at the gross level seem to be improving. But that improvement is just completely swamped by this massive and, importantly, deliberate 115% increase in corporate-level spending. That SG&A surge driven by things like hiring more people for growth, stock-based compensation, that's the measurable cost of transformation right there.
A cost of pivoting to AI.
Pretty much.
Okay, this brings up something else we see a lot. GAAP versus non-GAAP figures. Companies love presenting these adjusted non-GAAP numbers. Management uses them to, let's be frank, often paint a better picture. But for our listeners, how should we interpret them? Are these costs they're excluding just temporary growing pains, or are they, a permanent feature we need to factor in?
That's the million-dollar question, isn't it? Management presents non-GAAP because, in their view, it gives a clearer picture of ongoing operations. They exclude things they see as non-recurring or non-cash, items that might not reflect the core business performance day-to-day.
So what were APLD's numbers?
Well, their GAAP net loss from continuing operations was that $26.6 million figure. But their adjusted net loss from continuing operations, the non-GAAP number, was much smaller, $7.6 million.
Big difference.
Huge. And even more striking, their adjusted EBITDA, also non-GAAP, was actually a profit of $1.0 million. That's compared to a loss of $2.2 million last year on that same adjusted basis.
Okay, so what are the big things they adjusted out?
The most significant ones were adding back $11.6 million in non-cash stock-based compensation.
Okay, common adjustment.
Yep. Adding back $4.9 million they called strategic project expenses.
Related to the build-out, maybe?
Likely. And subtracting a $6.3 million gain they got from selling some assets held for sale, basically a one-off profit that won't repeat.
So management's story is?
Their narrative is basically, look, our underlying business model is fundamentally profitable if you just look past these specific temporary or non-cash costs. The decision point for you, the listener, is, do you buy that? Are these truly temporary costs on the road to something much bigger? Or are they just part of the ongoing cost of doing business for a company that's constantly reinventing itself and spending heavily to grow?
Right. Growing pains are permanent features. That's a really good way to frame it for analysis. Now for slide 3. The engine room business segment performance. Understanding the different parts of the business is super important here, especially for a company making such a big shift.
Absolutely. And what's fascinating, or maybe simplifying, is that Applied Digital classified its cloud services business as a discontinued operation,
Meaning?
meaning that effectively 100% of that $38.0 million revenue we saw in Q4 came from just one segment, their data center hosting business.
Okay, so let's break that down. First, what we're calling the legacy business. Data center hosting. Crypto focus. It's what's paying the bills right now, right? Operating data centers mainly for crypto miners up in North Dakota.
That's the one. It's the current financial engine.
And it performed well. Revenue up 41% year over year to that $38 million, driven by more capacity online. Management sounded pleased, said it continues to operate more efficiently, demand is robust, probably helped by decent Bitcoin prices.
Yeah, that legacy business is holding steady, even growing. It provides stability.
Yeah.
But like you said, it's not really the future they're selling, is it?
No, exactly. Which brings us to the future-facing business. HPC data center hosting, AI focus. This is where the whole story is now, isn't it? Even though it generated zero revenue in Q4.
Zero revenue, but 100% of the buzz. This is the entire forward-looking growth thesis. The key project is that Polaris Forge 1 campus in Ellendale, North Dakota.
The big one.
The really big one, designed to scale up to 1 gigawatt, specifically for AI applications.
Yeah.
We're talking one of the most ambitious data center projects in North America.
And the cornerstone is that deal with CoreWeave.
Absolutely. That 15-year lease agreement is transformative. Now, CoreWeave, for listeners who might not know, is an AI hyperscaler. They provide massive computing power tailored for AI.
Right.
The initial deal was huge, 250 megawatts, expected to bring in about $7 billion in revenue over the term.
$7 billion? Wow.
But wait, there's more. CoreWeave already exercised an option for another 150 megawatts. So the total commitment is now 400 megawatts, and the estimated contracted revenue jumps to around $11 billion over those 15 years.
$11 billion. That's
Yeah,
monumental.
it is. And the timeline is aggressive. They expect the first 100-megawatt facility at Polaris Forge 1 to be up and running in the second half of calendar year 2025.
So this really is a tale of two companies under one roof. You've got the Q4 financials reflecting this crypto hosting provider.
Right, the past and present.
But the whole narrative, all the excitement, is about becoming this major AI infrastructure player backed by this massive CoreWeave contract.
Exactly. That CoreWeave contract is what everyone calls a monumental de-risking event. It validates the whole strategy shift. Landing a blue-chip tenant like CoreWeave gives them huge credibility.
And helps with funding, I imagine.
Massively.
Oh.
It significantly eases the project financing needed for a build-out this enormous. They basically have a guaranteed high-value customer for a huge chunk of their future capacity. It's a massive vote of confidence.
Okay, that makes total sense. It really clarifies the two distinct parts of the story. Moving to slide 4, financial strength and shareholder rewards. This is critical, right? Especially for a company spending so much capital to build things. We need to look at their balance sheet, how they're managing money.
Definitely need to kick the tires on the balance sheet.
Okay, so as of May 31st, 2025, the snapshot shows cash equivalents and restricted cash at $120.9 million. Uh-oh. Total debt, $724.0 million.
A sizable debt load.
Total stockholders' equity is $497.7 million, which gives them, a debt-to-equity ratio of 1.45x.
Okay, 1.45x debt to equity. Now, in many industries, that would be considered pretty high. It definitely shows a significant reliance on debt.
That's what I was thinking, high leverage.
It is leverage, yeah. But context is everything here. This is a capital-intensive business building huge data centers.
Yeah.
Especially for AI, which needs cutting-edge, expensive infrastructure. Companies often use significant debt to build these large income-generating assets.
So it's maybe not as risky as it looks.
Well, the key mitigating factor is why they have the debt. A large chunk of the capacity they're building with this borrowed money is already pre-leased to CoreWeave. Under that multi-billion-dollar long-term contract, that makes the debt significantly less risky than, say, borrowing money for speculative R&D or something without clear revenue attached. It's debt tied to pretty predictable long-term income streams. So yes, it's aggressive, but many would argue it's a strategic, necessary use of capital for this kind of massive growth opportunity.
Okay, strategic debt tied to specific assets and contracts. Got it. Now let's talk about their capital strategy, because looking at the cash flow statement, it seems, well, a bit contradictory maybe, for you, the investor.
How so?
Well, the consolidated statement of cash flows shows they actually spent $31.3 million to repurchase shares during the fiscal year, buying back stock.
Okay.
But then, on the flip side, they were issuing shares like crazy. The number of issued and outstanding common shares grew 62.5% over the year, from 144 million to over 234 million.
Wow, that's a big jump.
And it didn't stop there. After the quarter ended, they raised another, $269 million roughly, selling even more common and preferred stock. So why buy back shares only to turn around and issue so many new ones? That dilutes existing shareholders, doesn't it?
It absolutely dilutes existing shareholders. And yeah, on the surface, it looks contradictory, but it actually points to, I think, a pretty financially savvy and opportunistic management team.
Okay, explain that.
It's highly likely the buybacks happened earlier in the fiscal year, maybe when the stock price was lower and management thought it was undervalued, or they just had some excess cash then.
Okay, timing matters.
Timing is everything.
Yeah.
Then the transformative CoreWeave deal gets announced. The stock price surges on all that AI excitement and future potential. What does management do? They pivot. They leverage that much higher stock valuation.
Sell high.
Exactly. They sell new shares at those much better prices to raise the huge amount of capital they need for the massive data center build-out, the very project the market was suddenly rewarding them for.
So use the momentum to fund the dream.
Precisely. So if you're an investor, yes, your slice of the pie is getting smaller today because there are more slices. But the promise is that the whole pie is going to get much, much bigger tomorrow because of this AI expansion.
The price of participation.
That's a perfect way to put it. It shows astute financial management, but it also clearly lays out the deal for investors. You have to accept significant shareholder dilution as the necessary cost to finance what could be a generational opportunity in AI infrastructure.
That explanation makes a lot more sense now. Opportunistic, not contradictory. Okay. And finally, slide 5, the road ahead management's outlook and key takeaways. This is where we pull it all together, synthesize the analysis, look at management's vision, and boil it down. So what was the tone from Chairman and CEO Wes Cummins? Overwhelmingly forward-looking, right?
Completely. All about the future.
On the CoreWeave deal, he said something like, these long-term leases mark a defining moment for Polaris Forge 1. Pretty clear.
Him setting the stage?
Yeah. For future growth. Building on the momentum and the surging demand for AI infrastructure, we're actively marketing our multi-gigawatt pipeline. So more deals potentially coming.
That's the implication.
On execution, he highlighted improvements. Over the past 2 years, we've streamlined our processes, reduced projected build times from 24 months to 12 to 14 months. That's a big claim.
Efficiency gains are key for builds like this.
And the overall vision. We believe the future is very bright for Applied Digital. We're confident that our multi-gigawatt pipeline should continue to drive our growth. Pretty bullish.
Very confident tone, focused entirely on the AI build-out.
Now, Cummins mentioned streamlining processes, cutting build times. That sounds great. But, building a 1 gigawatt project is still just enormous. What are some of the real-world challenges or risks in pulling off something that big, even with a partner like CoreWeave and signed contracts? Are there other potential headwinds they might face?
Oh, absolutely. Those are critical points. Vision is one thing, execution is another. Projects this size, no matter how well planned, always have risks. You're talking massive capital outlay, incredibly complex supply chains, things specialized transformers, cooling systems, that kind of thing.
Delays, cost overruns.
Exactly. Potential labor shortages, construction cost inflation. Energy costs are always a huge variable for data centers, and you never know when regulatory hurdles might pop up. So while CoreWeave de-risks the demand side, actually building it on time and on budget still requires flawless project management and navigating all those potential pitfalls. It's a massive undertaking.
But potentially massive rewards if they pull it off.
That's the bet in the AI infrastructure space right now.
Okay.
Now let's tie this all together with the key takeaways. What does this quarter really mean for APLD?
Let's hear them.
First, a strategic pivot overshadows a headline miss. That Q4 revenue miss. Honestly, it feels almost irrelevant compared to the potential $11 billion CoreWeave contract. That deal fundamentally validates their huge shift to AI infrastructure.
Okay, the deal is the real news. Second, investing for hypergrowth sacrifices near-term profits. This quarter was all about deliberately sacrificing current profitability. We saw it in the operating margin collapse, that negative 54.5%, driven by the 115% SG&A surge. That's the tangible cost of building out their AI future.
Paying now for growth later.
Third, The price of transformation is shareholder dilution. They're funding this future with significant debt, that 1.45x ratio, but even more so by issuing tons of new shares. Diluted share count up almost 80% year over year. As an investor, you're betting the future AI growth will create way more value than this dilution destroys.
A big bet.
It is. And finally, fourth, investing in the before picture. These Q4 financials, they're a snapshot of a company right on the edge of a massive transformation. Actual revenue from the new AI business won't even start until late calendar 2025. So investing today is really a bet on management's forward-looking vision, albeit a vision that's now significantly de-risked by that huge CoreWeave contract.
That sums it up really well. So the final narrative seems pretty clear then. Fiscal Q4 2025 marks this pivotal transition point for Applied Digital. Definitely a turning point.
It's the moment they really shift from being, a crypto hosting provider to aiming to be a core enabler of the whole AI revolution. That revenue miss might grab headlines short term, but it's looking backward.
A lagging indicator.
Exactly. The real story is in the management commentary, the CoreWeave deal, the future plans. It presents a very clear choice for you, the investor. Do you focus on the modest, backward-looking financials of the old business? Or do you buy into the forward-looking, contract-backed story of a company trying to place itself right at the heart of a generational tech build-out with all the risks and potential rewards that come with it?
And that's precisely why using a consistent framework, like we do, helps any investor see past just the headlines. This structured approach lets you identify the real drivers, assess the financial health, understand the outlook. It's about building that deeper understanding over time for any company.
So what does this all mean for you?
Maybe consider this. How often do a company's past financials tell a completely different story from its future potential? Recognizing that difference, seeing beyond the immediate numbers, can be absolutely key when you're evaluating any investment.
Okay, before we wrap up, the necessary reminders. Please remember, this deep dive is for informational purposes only. It does not constitute financial, investment, legal, or tax advice.
Always do your own homework.
Absolutely. You should always conduct your own research and consult with a qualified financial professional before making any investment decisions. Also, please be aware that this report was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data.
And while it's designed for accuracy,
Errors or omissions might still occur. So please, all information, including financial data and calculations, should be independently verified by you. Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.